Well, hello again, everyone, and thank you very much for taking the time to attend this Orchid Inter-Entity Suite webinar, where we're going to show you how you can make inter-entity or intercompany transactions easy. We start off with a brief overview of the Inter-Entity Suite, which includes two components, inter-entity transactions and inter-entity trade. Inter-entity transactions is where we balance intercompany transactions in general ledger loan accounts, the due to, due from type entries. Whereas inter-entity trade balances intercompany transactions in the subledgers, either AR to AP or OE to PO, and it can go in either direction, bidirectional. So as we start the presentation today, let's start with a brief overview of who Orchid Systems is for some of you who may not know much about that company. And then we'll walk through a number of scenarios today to show you how you can use inter-entity transactions to accomplish time-saving, effortless intercompany transactions. Orchid Systems has now over 7,000 sites worldwide in 80 countries, has been in business for over 25 years, working with over 450 Sage business partners, primarily in the Sage 300 reseller channel. They're based out of Sydney, Australia. They've won many industry awards, and they now have 16 integrated modules for Sage 300, plus their latest release, an EFT processing module for Sage Intacct. On average, Sage 300 customers have at least 2 Orchid modules per site, and we're finding that over the last couple of years in particular, that larger businesses who are investing in the Sage 300 platform are generally using 3 to 4 Orchid modules. And why is that? Well, Orchid consistently provides excellent technical support on their applications. 88% of their support cases are addressed within 24 hours. And as a result of the quality of the products and the technical support behind them, Orchid has experienced annual average growth of 23% for the past 17 years. Now, what are those Orchid solutions? Orchid breaks out their applications based on business themes. The first one, collaboration. This includes the Orchid Notes and document management link solutions. Next, tailoring, automation, and integration, which includes the Extender product that most of you have heard about, where you can incorporate email alerts, audit logging, configurable workflows, customizable scripts to customize screens, automate processes, and integrate Sage 300 with external applications. There's also the process scheduler for scheduling administrative processes such as running day end, posting batches, and running data integrity checks. The new remote action service, which allows remote access through documents where you can sign and approve transactions that generate entries within Sage 300 without having to log into Sage 300. And Workflow Anywhere, which is a mobile app that supports workflows within Extender. Today, we're focusing in the area of streamlining financial processes, which includes the EFT processing, which will be the subject for next webinar in a couple of weeks. And today's focus, inter-entity transactions and inter-entity trade. There's also a collection of applications within budgeting, reporting, and business intelligence, which includes the OLAP Data Cube tool called Info Explorer that runs SQL queries against the database of Sage 300 so that you can filter and format data as a user. There's the optional tables, which allows you to create the optional fields in a multi-dimensional table. Report Runner to automate the generation and distribution of Crystal and FR financial statements. And Data Views, which allows you to eliminate sub-reports in Crystal so that your Crystal reports run much faster. And finally, Operations and Inventory Management, which includes the RMA, Return Material Authorizations module, bin tracking, and Freight Smart Link. But as we've talked about, we're focusing on streamlining financial processes today, and more specifically, inter-entity transactions and inter-entity trade. The inter-entity suite allows you to streamline the process of generating automatic transactions within one or multiple Sage 300 company databases so that it eliminates duplicate manual data entry, increasing the accuracy of your financial data to reduce errors. And reporting from our client base, they tell us that they're saving at least 2 days a month, not having to manually reconcile the due to, due from transaction balances. Inter-entity transactions, as we've mentioned, allows you to generate general ledger entries across multiple companies or within one company at a GL segment level to automatically generate your due to, due from intercompany loan account transactions, which automatically keeps every company in balance. This also includes cash management entries for bank transfers, as well as paying or receiving cash on behalf of related parties. Inter-entity trade, as we've mentioned, supports subledger transactions between accounts receivable and accounts payable, or order entry and purchase orders, so that reciprocal documents get created automatically without you having to go into each company and enter those transactions manually. In more detail, what inter-entity transactions is doing is facilitating these allocations of expenses or revenue or transferring cash between related entities. And because this is done by GL segment, where you define at least one segment as an entity segment, but that segment might be a fund for a not-for-profit organization, or you might even do it at a departmentalized level within a general ledger. Regardless of how you define your segments, inter-entity is using that segment to determine when it needs to create an intercompany loan account transaction whenever an entry goes across different GL segment codes. You define transaction routes that allow you to generate these transactions directly to target company databases, or you can clear these entries through subsidiaries or through holding or management companies. There's also a GL triggers function, which allows you to move these loan account balances down into AR or AP subledgers, at which point we would use inter-entity trade to create a due to, due from invoice. But rather than leaving that in the loan account in the general ledger, we create an actual AR AP invoice so that there are invoices to settle. The multi-database edition also includes the ability to run a consolidated aged AR or AP trial balance. What this does is it subtotals a vendor or customer outstanding receivable or payable amount by company and then shows a grand total across all companies for a consolidated view of the receivables or payables to that customer or vendor. There are also reports and inquiries that allow you to validate the loan account balances to ensure that you are in balance across all companies. And in the case of cash management, you have the ability to transfer bank money or payments and receipt transactions across multiple companies. As we move to inter-entity trade, this again is where we're generating transactions through the subledgers, which are typically buy and sell type transactions, or as we call them, trading transactions. This might be where you're creating an AR invoice to charge a related party management fees, or an allocation of expenses where you want the balances set up in the subledgers, or where you're moving inventory or buying and selling inventory through a manufacturing company to a sales company, and then from that sales company to the ultimate end user customer. This comes with comprehensive audit logging so that you can see all of the transactions and anyone can go back and validate where the entries are being generated. This mirrors buy and sell transactions, as we've said, between ARAP and OE and PO. And also you can have corresponding receipt and payment transactions within AR and AP. Between OE and sales order, purchase order, we have the ability to create sales orders to purchase orders, OE shipments to PO receipts and OE invoices to PO invoices. And in the case where we do bidirectional processing, we can modify any of the transaction details and they will automatically update in the other company's transaction document. So what we're going to do today is take you through various scenarios, starting with an AP expense allocation using intercompany GL loan accounts, and then we'll generate a bank transfer to settle the loan accounts. So let's go ahead and show you how that's done within inter-entity transactions. First, we would set up the AP invoice so that we can establish the expenses that need to be allocated. And in this case, it's an external AP vendor transaction that we want to create in order to be able to determine the expenses that we want to allocate. And what we're going to do is show you two different scenarios. One where we've hard-coded the expense accounts in the chart of accounts of this source company, Company 1 or Orc Limited. So this will be, let's say, an intercompany allocation of office supplies expense. Now this could be rent, this could be telephone, any type of expense where one company is incurring the transaction expense for other related party companies. Now what you're seeing on the right-hand side here is Document Management Link, another Orchid solution. And we highlight this because in a case where you're dealing with intercompany transactions, especially the allocation of expenses, it makes sense to provide supporting documentation with the entry. So we generally demonstrate inter-entity transactions with the use of Document Management Link. And of course, when we generate an entry for a vendor, we can see all of the vendor invoices. But then when we set up an individual invoice, the system will give us an open window where we can add a supporting document for that specific combination of vendor and invoice. So if we wanted to add that, even though the document might be called something else, like in this case Jaguar F-Pace, when we attach that document, it automatically renames the document to match the corresponding entry within the document number field. And then this invoice can move from AP in the source company up to general ledger. And then as we move the expense allocation to another target company database, this document will flow with the transaction over to that other company database. We're also going to use the concept of a distribution set, where you can predefine a % or dollar allocation among companies. And so we like to show this feature as well because it streamlines the data entry as well. We're going to remove the line that's not necessary, and then we're going to eliminate the tax because we don't want to complicate the entry for demonstration purposes. Now, of course, particularly if you're in a VAT tax region, you know that you can't necessarily just eliminate tax, but you might then have the issue of whether you're going to keep that tax within the source company that's paying the AP invoice, which generally makes the most sense, or whether you're going to share the input tax credit with other related party companies. So we've eliminated the tax, but notice that the transaction entry has an office supplies expense account 7900-1 and office supplies 7900-2. It's the -1 and the -2 that signify the entity that we want these expenses to be allocated to. We're going to go ahead and add this as an entry in the system, and then we're going to create a secondary transaction, but this time it's going to a different vendor called 1350. And in this case, it's going to be a GL trigger entry, a GL entity substitution entry, where we have not set up the account for the other companies in this chart of accounts. So when we set up this transaction and we want to allocate the amount, what we want to do is, and let me just highlight this here, we're going to be generating a loan account using what we call GL entity substitutions. Because in this case, we don't have an actual account set up for the expense that we want to create. So coming back to the transaction entry, we can enter a GL account for the expense, and we'll choose a 6,000 expense account. So let's say that it's accounting fees, and it's $600. And then we're going to insert another line, 6,000 as well. So you notice in this case that both accounts are showing as accounting and legal fees, 6,001. The amounts are different, but we're going to use an optional field to determine which entity this transaction should go to. Now, because we've used Extender to put the optional field into the grid, this may not show exactly the same way in your sample company. But the point here is that we're using this entity code to determine which company that allocation is going to. So when we save the optional field, we want the entity to show here as 2, not 1. And then we will add that entry and enter the document number 739 as an example. And of course, we could then add that document to this transaction as well. And once we've added that, you notice that the entity now shows as 2, even though the account is still the 6,000-1, because we're using the optional field to identify which entity this transaction should go to. So we've added that transaction. We've got 2 entries now in our batch, one that's using the hard-coded entry, one that's using the entity substitution. So we'll go ahead and we'll post that AP invoice batch up to the general ledger. We'll take a quick look at what's been posted in the GL, and then we'll post that through to show you the impact of this entry on the system. So, sorry, didn't mean to. Let's close that and post. So at this point, interentity transactions hasn't done anything. All we've done is set up the appropriate entries to mark the expense. As we go up to the general ledger and look at the transaction batch, there's the entry for today, March the 9th. Let's open that up. There's the first expense entry, an invoice 632, which is in the description column, and there's the supporting document that is moved up from AP to the GL, so it's visible at the GL level. And we notice that we've got an expense entry for $1,200 and $800 against a credit of $2,000. So our credits and our debits balance. But when interentity looks at the transaction, it sees that $800 of the expense has been allocated to entity 2, and $1,200 is staying in entity 1, denoted by the -1-2 on these accounts. So what interentity transactions does, when it sees a transaction entry that goes over 2 different segments, it will add additional lines to the batch with an IY source type to identify the loan account balances that need to be created in order to balance the debits and credits at the individual company level or GL segment level. Likewise, this entry here, even though they're all -1 accounts, we're using the optional field value to determine when an intercompany loan account entry needs to be created. So this will still generate a loan account entry, except that it's going to clear through an entity substitution clearing account, because we don't actually set up the hard-coded accounts to do the expense allocations. And to be honest with you, this is not used as much has people hard coding the accounts just because it's easier for data entry to actually have the hard coded accounts. But in some cases, clients have said they don't want to replicate the chart of accounts across every company, so they use the entity substitution method. But let's go ahead and post. But before I do that, I want to change my period here to 2020. And this entry, I'm going to change. I'm going to save. And this one I'm going to enter as 2020 as well. And save. And then we're going to go ahead and post. And you will see a number of entries get created through the inter-entity processing. They balance, and then they export to company 2, which is setting up the transactions in the GL of company 2, which is the target company. And there you have all the additional lines of entry that are required. So in this case, because there's entity substitution through the optional field, you see the IS source type, which is inter-entity substitution, and then the IY, which are the loan account entries. And then you see the reversing entries, which is an option you can choose if you want to reverse the impact of the loan account entries being created. So let's use our drawing tools to highlight what's happened here. We had the original AP invoice entry, $1,000 going to our AP trade account, and the $600 of that going to accounting and legal fees in entity 1. And then inter-entity created this balancing entry of $400, which is an intercompany receivable in company 1's books, which is due from company 2. And there's my balanced entry within company 1. Now, likewise for company 2, because we used entity substitution, the first thing it did was move the balance into a substitution account here, which now has a -2 associated with it, which is our entity 2 clearing account. And then, because it now has a separate segment code to use, it does the same type of balancing entry where it creates an intercompany payable that's due to company 1 in company 2's books. So these two lines in the batch, the clearing account and the intercompany loan account, are what's going to get sent over to company 2's database. And then once we hit company 2's database, you'll see how the clearing account gets substituted by the 6,000 expense account. So that's how we balance the entries through the loan accounts in a case where we have an entity substitution. If we have the regular type of transaction where we're not using entity substitution, but hard coding the account, then we have just the IY balancing entry through the loan account. So in this case, it's a little simpler, which I think is another reason why people prefer this method. So in this case, we had a $2,000 credit to payables, $1,200 stayed in company 1, and then we created the loan account intercompany receivable that's due from company 2 in company 1's books of $800. So there's my balanced entry for that expense allocation entry. And then company 2, the office supplies expense, gets balanced through the loan account, which is an intercompany payable due to company 1 in company 2's books. Now the reversal, as I mentioned, is just going to take the original debit of $800 in office supplies and credit that out. And the credit that was created to balance the entry gets debited out. So the office supplies expense is a net 0, and the intercompany payable is a net 0, because those transactions are now in company 2's books. And you can choose to leave them as they are, or you can reverse them out to zero out those balances. In the end, it doesn't make any difference, because when you run your trial balance, the intercompany accounts will all net to 0 anyways. It's just that your total debits and credits would be higher. So it's really a matter of preference as to whether you want to keep those transactions or reverse them. So there's our entries within entity 1. Next, what we're going to do is take you over to entity 2 so we can see the impact of these intercompany transactions and how they look within company 2. So when we move to company 2, we'll have 2 entries in the general ledger. which highlight the loan account processing that takes place. So here within General Ledger Transactions, we open up the batch, and we have an entry from today, March the 9th. And here's the first transaction. Remember, we had the invoice 632 that was entered for office supplies expense. So that is a supporting document to this transaction, which has set up the office supplies expense of $800, offset against the loan account, which is the intercompany payable due to Company 1 in Company 2's books. So that's how we've created the loan account to balance the transaction, and then we send that entry over to the target company database. In the case where we used entity substitution, we have a couple of extra lines where we have to enter the transaction first using the entity clearing account. So the debit of $400 ends up here. We clear that out and we set up the debit to the accounting and legal fees account, which is where it belongs, and offset that against an intercompany payable that's due to Company 1 in Company 2's books. So as you can see, either method works, whether we're hard coding the chart of accounts for all the expenses in Company 1, the source company, or whether we want to use entity substitution and not replicate all those expense accounts in the chart of accounts, but rather use an optional field to designate which company we want these entries going to. But in either case, we've got loan accounts that need to be settled. How do we settle those loan accounts? Well, if we come back to Company 1, what we do now is we set up a bank transfer entry in cash management or in bank services. So under bank services, common services, bank services, we want to do a bank transfer. And so let me go over, I'll just highlight this quickly for you because we've scripted out these demo transactions, which are actually part of the sample data that you can get with this module if you'd like. We want to do a bank transfer to settle the loan accounts. So what we do is we enter a bank transfer entry where we're going to take money from Entity 2's bank account and move it over to Company 1's bank account and clear those entries through loan accounts so that we settle those balances. So when we do the bank transfer, because it's a payable in Company 2 owing to Company 1, we're going to transfer cash from Orc Inc. 2 to Orc Limited, which is Company 1. And notice as well in this example that we're using multi-currency. So we're going to transfer from Company 2's bank to Company 1's bank. And let's say it's the $800 expense that we allocated for office supplies, and it automatically translates that to the home currency equivalent in Company 1, which is Canadian dollars. So just as you would handle multi-currency for other entries, we handle the entries the same way using inter-entity transactions. And what we've done is we've auto-posted the entries from bank services up to the GL in each company. So we will see not only the bank entries being generated, but they'll auto-post up to the general ledger in each company. And because these entries are clearing through bank services, it means that they'll also automatically appear on the bank rec within each company. So here in the source company, we have a general ledger transaction which has been created from bank services. So it's going to have the BK format. And there's actually two entries here. One is the clearing entry, where we set up the original transaction, where we're debiting our bank account for the Canadian dollar equivalent of $800 US, and using the bank clearing account that represents the real bank account in Company 2, which is $800 US. And that's settling the amount owing from the related company, Entity 2. So if we drill back, we can see the transfer entry that we just created. Now the other side of the entry will set up the loan account balance. So in this case, we have the credit to the loan account, which reduces the receivable. and the offset is that bank clearing account. So if we combine the two entries, the first one had a credit to this clearing account and a debit to our bank to acknowledge the deposit, and the other entry here shows the offsetting credit to the loan account, which reduces the intercompany receivable, and it clears through the bank clearing account. And if we were to look at the bank entry within bank services, this would show you the deposit entry that was created in bank services to offset the outstanding receivable. So there's the deposit entry. So that's how you know it's going to hit the bank reconciliation. And the offset is the loan account to reduce the outstanding intercompany payable. In our case, offsetting the receivable because they owed us the money. Now in company 2, the bank entry is much simpler because we're not using a clearing account here. It's just offsetting the loan account. So in the general ledger, we see a batch created from bank services. And there's the bank entry from today's date, March the 9th. And here we have the credit to their bank account, which was a withdrawal, and the debit to their intercompany payable. And if we drill back to bank services, we see the bank entry, which is a withdrawal from their bank account. So we've settled the loan account intercompany due to due froms by doing a bank transfer and allowing the loan accounts to offset so that we clear the balance that was outstanding in the intercompany due to due froms, but also recognize through bank services a withdrawal in one company and an offsetting deposit in the other company, which then automatically appears in the bank rec. Now we could have done the same type of entry if we had paid an invoice through accounts payable. So if we had come here and set up a payment entry to offset the invoice that was created, then what we do in this case is we point to company 2's bank account here when we're making the original payment. And when we do that, then the system knows that I'm going to set up the payment entry. This is actually company 2. We would do that in company 1. So let me flip over there quickly. And the net effect is the same because instead of just doing a bank transfer entry, we're acknowledging a payment entry, but we're actually going to pull the money from company 2's bank account. So we end up with the same loan account entries in bank services. It's just that we've established this as an AP payment. So we're in company 1, but we point to company 2's bank account, and then we can make the payment against an outstanding invoice, and it will still create the same type of bank service entry. So in either case, we're clearing the loan accounts, whether we're doing a bank transfer or a payment entry in AP, and we would be paying that original AP invoice that we set up, the invoice 639 or 632 that we set up to the external vendor. And either method works fine. But we need to move along to the next scenario, and that is if we paid that AP invoice. Actually, we'll skip over this one in lieu of time and move to the AP expense allocation with AR to AP. And in this case, we're using a GL trigger that allocates the debit amount in the GL loan account and sets that up as an AR invoice. And then with a combination of the trigger and an associated AR AP trade invoice, we create an expense allocation, but in this case, it's not left in the GL and a loan account. It's actually set up in AR and AP. Okay, so we're going to do scenario 4 next, where we're going to move through this example of creating an AP invoice for lease equipment that we're paying through entity 1, but the expense belongs in entity 4. So we're going to be using this account here, the lease equipment. So let's do another AP invoice transaction. and we'll highlight for you the customer-vendor relationship that's been set up in AR AP trade. So this is expense allocation AR trigger to AP. Okay, so expense allocation AR trigger to AP. And we're going to use this distribution code, or sorry, this GL account. And let's say it's $600. And just to highlight here how this has been configured, when we look at the configuration within inter-entity transactions, we're using this feature, the GL triggers. And what we've said is that we want to trigger an AR reallocation whenever an expense entry goes to this account 7264-1. And the AR reallocation is going to go down to AR and create an AR invoice against entity 4. And then with the combination of the trigger and then the trade relationship that we have set up, when we do an AR invoice to 994, the trade relationship says, take that AR invoice information, go over to entity 4's database and create an AP invoice back to entity 1. So it's this combination of trade with the trigger entry here that is creating the ability to settle the inter-entity balance or create the expense allocation through the subledgers by using this trigger account 7264, allocating down to AR to the customer account 994, which then creates the AP invoice in entity 4's database back to entity 1. So it's a combination of a GL trigger and the AR AP trade that we've set up within the system. So lots is going to be happening here in this entry. So when we do this transaction, we're going to just set up the one entry of $600. And again, we'll eliminate the tax. And there are no taxes involved, which is great. And then we set up a document number, 720. And we'll go ahead and post the transaction. We'll add it. Oh, I guess it's added the tax now. Let's go back. Okay. Oh, I see. 6,000. Sorry about that. Had an extra zero there. So let's make this 600, and there we go. Now we can save and post. So again, we've just entered the AP invoice. And now when we get up to the general ledger, you notice that it's posting to the general ledger that creates these entries and causes inter-entity transactions to do its thing. So there's the entry. All of these entries belong in entity 1, but because of the trigger and the relationship between the trade, this is going to get moved down to AR, and then we're going to see the AR AP trade message pop up as well. So let's post this entry. There's the inter-entity transaction. So there's the trigger to create the AR, and then the trade transaction, once we post the AR invoice, creates the AR to AP trade entry. All right, so all of that's done with the posting of this GL batch. And there's the AR entry that's created in this company to acknowledge that we wanted to set up an AR invoice rather than an intercompany receivable in the loan account in the GL. So we've actually created an AR intercompany. And if we drill from GL back to AR in this company, we see the AR invoice has been created against Entity 4. So it's receivable from Entity 4 for the amount of $600 against our equipment lease or rent recovery account. And now when we go over to Entity 4, we should see an AP invoice that's been created against the AR invoice in Company 1. So here we should see an invoice batch in AP for $600, which sets up the liability in Entity 4 to offset the recovery of the expense that's been now set up as an AR invoice in Entity 1. All right, and the original invoice document could have been sent across here as well because we put that into the description as part of the audit trail. And you can determine, if you notice here, these are what we call integration settings. We can create a nice audit trail. In this case, it's telling us which company the original invoice was generated from and the invoice number. And this has the posting sequence, batch number, company, and the user who set up the original entry in AP for this transaction. So that's how we handle a transaction where we want to allocate an expense but not leave it in the GL loan accounts, but settle it through AR and AP invoices. Speaking of settlement, now that we have that AP invoice in Company 4, if we wanted to create a settlement where we offset an AR receipt against an AP payment, then we would do what's called a bi-directional transaction between AR and AP. So this is now part of AR AP trade. So what we want to do is we want to create a transaction now in Entity 4. So we're going to enter an AR invoice to customer 9003, which represents Entity 3. And when we post the AR invoice, it will create an AP invoice in Entity 3. But then we'll pay the AP invoice in Entity 3, which will then go back to Entity 4 and create an AR receipt. So that's the bi-directional nature of the transaction. So heading back to Entity 4, we create an AR invoice in Entity 4. And this is a new entry. So this is AR to AP bi-directional. And the customer is 9003. And we want to use the, let's go here to a summary invoice. Use the distribution code DELV. And let's say this is $400. And we're going to add this as an invoice. And that's all we want to do is create this transaction. We'll do it to 2019. Save and post. Now there's the AR trade to the AP trade. So this is just directly going from AR to AP. So now within Entity 3, I will have an AP invoice. So when we open up our AP invoice batch list, there's the $400 AP invoice that was created against the AR invoice. And this is the invoice that was created for us. Notice that the document number incorporates where the original AR invoice came from, Orchid 4, and the document number with a total of $400. So if we post that AP invoice, we now have an invoice to settle, as opposed to doing a bank transfer or moving money through the loan accounts. We actually want to do a payment entry to pay that AP invoice that's outstanding to Entity 4. So this is an AP trade payment to AR. And the vendor is 9,004. And we want to search on the document, which was this one here, which is our $400 amount that was owing. So we're going to say, yes, we're going to add that as a payment, and we want to post that entry. So there's the $400 payment. We will print the screen and post. And what Inter-Entity Trade will do in this case is, because we've got associated documents, the AR invoice in Company 4 and the AP invoice in Company 3, when I pay this invoice in Entity 3, making payment to Entity 4 of $400, the system will automatically go and generate the AR receipt. So there's the AP, and then you'll see the receipt processing in AR. That happens fairly quickly. So we've got the receipt entry against the the payment entry in Company 3 against the AP invoice. And now we go back to Company 4. And we will see an AR transaction for the receipt batch. And there's the receipt batch that was created against the original AR invoice. So invoice 21 has now been paid. Okay. So that is an example of AR AP trade bidirectional, where we set up the AR AP invoice. In this case, the AR invoice is created first, created the AP invoice, then we paid the AP invoice, and it went back and created the offsetting AR receipt. The final scenario that we're going to show you today involves OE and PO trade bidirectional, where we're creating an order in Entity 3, entering a purchase order, and this will create a sales order in Company 4, and then we'll ship the sales order in Company 4, which will then do the PO receipt in Entity 3 or Company 3. And we'll show you modifications to that transaction as part of this entry as well. So in Entry 3, we want to create a purchase order. So we're going to do a PO transaction, and we want to buy from Entity 4. So this is an example where in some cases we have transactions where we actually chain the entry. A sales company sells to a consumer, an end consumer, but they don't have the inventory. So the sales order in the sales company creates a purchase order to the manufacturing company, which then creates a sales order in the manufacturing company back to the sales company. And that's what we call a chained entry. In this case, we're just keeping it simple, going between OE and PO. So as we mentioned, just to highlight this again, we're going to enter a purchase order to vendor 9004 on any item. It's any non-stock item. We'll just use this one as an example. And that will create this sales order in Company 4. So let's do that PO to vendor 9004. And we'll just choose this item number here. And let's say location 1 for a quantity of, let's say, 50. And we'll go ahead and post that. And when we post that order, we're going to generate a PO, which has created a sales order in Entity 4. So purchase order 67 has created a sales order 108. So now when we go over to entity 4, sales order 108 is there. When we go down to OE transactions, and our last sales order is 108. Notice that the reference says it came from entity 3, the user who set up the PO, and the corresponding PO number. Now we look at the sales order and we say, well, they wanted to purchase 50, but we only sell in even dozens. So we're going to say it's actually 60. It should be 60 and post the order at 60. So what happens is, because we've got the bidirectional relationship between the two companies, when I modify the quantity to 60, what happens is the PO within entity 3 also gets adjusted from 50 to 60. And so when we open up that PO in company 3, the inter-entity relationship has automatically updated the quantity ordered on their PO to 60. And then they come back and say, well, if I have to order in quantities of 12, I don't want 60, I'll take 48 instead of 50 and post that back. And so you can have these people going back and forth making modifications to these documents if you want. So now when we go back to the sales order in entity 4, it will have a sales order amount of 48. And then what we'll do is we'll ship and we'll invoice, and you'll see how the PO receipt and PO invoice get generated as well. So there's our sales order, and the quantity has been updated to 48. So we'll stop, we'll ship all. So we'll go ahead and change the quantity shipped here to 48. We'll create the invoice, and then we'll post. And by posting, we will see that both the PO receipt and PO invoice are created against an OE shipment and an OE invoice. And this will be the last transaction that we show you today. There's PO receipt 109 against shipment 93. So 109 PO receipt against shipment 93. And then the next documents are the invoices. They're both 93. So PO invoice 93, OE invoice 93. So when the information gets updated here, we have shipment and invoice 93 here in this company. And in company 3, we have the PO receipt 109 and invoice 93. So if we went to the invoice entry and we wanted to see invoice 93, there's a different sequence of numbers here, so I have to actually search for invoice 93, which is down here. There's the 48 that was ordered against PO 67 and purchase receipt 109. So the entire transaction has been completed now. Whether you want to automate all 3 levels of the process is really up to you. You may want to wait until physically the inventory has been received, but this gives you the ability to generate these transactions quickly and easily to record the movement of inventory between related parties. So now, we've gone through all these different scenarios. We showed you an AP invoice allocation with loan accounts and also with a trigger doing ARAP. We settled through a bank transfer entry, and we also could have paid the AP invoice from entity 1 to entity 2 bank account. We did an AP expense allocation with the triggers to ARAP. We did a straight AR to AP trade invoice, and then we settled through an AP payment, creating an AR receipt. And then lastly, we showed you PO to OE bidirectional trading transactions. So in the remaining minutes, if you have any questions, you can post those in the chat. But before we do that, I just want to highlight one other thing, because we get this question quite often, and that is, what about consolidations? The inter-entity transactions modules are intercompany transactions modules. They are not consolidation modules. As you know, Sage has a GL consolidation module. But inter-entity does support consolidation entries. So within inter-entity transactions, you have the loan account balances, which has both a report and an inquiry to support the balancing at a consolidated level for all of your companies. So if I come back to company one here, I can show you the inquiry for the loan account balances. And when you use that inquiry or generate the report, it validates for you that all the intercompany payables and receivables have been offset, so that when you run the query, and this is also multi-currency, you can verify that the loan accounts are zero on both sides. This source balance and that source balance net to zero. The debits and the credits, the receivables and the payables between intercompanies are all balanced. And that verifies that your loan accounts are in balance. The other thing that inter-entity does for balancing between trading partners is that you can create elimination entries when you're doing AR and AP. So if you want a GL entry to be created in an elimination company or a consolidation company, you can do that for every AR AP invoice transaction that you create. When we look at OE and PO trade, what you can do there, particularly where you need to eliminate intercompany profits on intercompany sales, you can either define a specific IC category or a specific IC location where you can isolate intercompany transactions, and then it's easy to identify which intercompany sales and profits need to be eliminated upon consolidation. And this is used so that when you run your intercompany sales through the IC price sales analysis reports, you can identify which profits and sales need to be eliminated. Okay. So if there are any questions, now is your opportunity. If not, we appreciate your time. We know we covered a lot of ground today, but we hope that you found that useful to show you the power of what's involved in doing inter-entity and inter-entity trade transactions and how it saves a lot of duplicate manual entry by automatically creating offsetting documents within or across related party company databases. So if there are no questions, thanks again for your time and attention. We hope you have a great day.